I am both delighted and humbled that our next speaker accepted my invitation to lead off the event today. And when we met now several months ago, his formative ideas on what he wanted to discuss got me really excited that we'd be in for a real treat. Dennis Mahoney, former chairman and CEO of Aon Group Limited and chairman of Aon Global and currently executive chairman of RFIB Group, is our first speaker, and it's my great pleasure to welcome him to the stage. Dennis.
Thank you, Arthur, I think. When Arthur called me, he said, Dennis, I'd like you to speak and be controversial, because at your age it doesn't matter anymore. Thank you, Arthur. So let's try to be controversial. Bring out your dead. Bring out your dead. You may or may not be familiar with this particular picture. It's London, 1665, bubonic plague. People are dying by the scores. Each parish at that point decided that what they should do is to employ some people to go around to each of the houses with a bell and suggest they bring out the dead. And people were actually employed to put them on the barrows and take them away. They were known as searchers of the dead. Quite an interesting occupation when you think about it. Part of their job was to recognize whether the unfortunate had actually died of bubonic plague or what they called consumption. In the event that they decided it was a bubonic plague, the house was sealed up and the people inside would die anyway from lack of food and water. Needless to say, that led to a certain amount of bribery of the people going around and identifying the cause of death. Fast forward, London, 2018, for whom the lutein bell tolls. Not plague this time, but Lloyd's Performance Management Office, also affectionately known by some as the Grim Reaper. I can do no better than put up the headline that appeared in the Insider. Lloyd's takes ruthless measures to reverse underperformance. 2 syndicates were stopped from trading. The bottom 10 decile performers were named, as were the top. It just reminded me of the Great Plague, where they put a cross on the door of the house that was doomed. Perhaps an unfortunate analogy. In any event, it leads to some fundamental questions as posed by Richard Brindle. Is it a unitary entity collaborating, or is it a whole bunch of competitors scrambling around, biting each other in a barrel and tide that you can't articulate this bold vision? He goes on to say they can't impose the vision. The fundamental problem is if they overreach. They can do it with perhaps smaller syndicates, but if they try it with Beazley or Hiscox, they'll say, I'll take it to my company market platform. I have a somewhat different view from Richard. I actually describe what's going on as dirigiste. It's a wonderful sort of French term, isn't it? Which means more direction from the center. Okay? Now, sometimes economists criticize this because it means governments are choosing national champions. And is there the suggestion, therefore, that Lloyd's Central is choosing the champions going forward? I don't think so. I think that's entirely appropriate, just my personal view. Now, leaving all that to one side for the moment, let's go back to the big picture if we can, and the chap from the FT touched on this earlier. We can agree, I think that insurers make money in only 2 ways. Either your premiums exceed the claims, or you can make it up with investment income. We used to call that cash flow underwriting. I thought you might enjoy this slide. And before anybody says, who knows what happened 5,000 years ago, this is from the Bank of England. Kind of interesting, isn't it? Interest rates over 5,000 years. I did wonder whether it was my ex-mother-in-law had been involved in that, but in any event. I looked up a quote on this. I thought it was quite interesting. Einstein was once asked what was the most miraculous thing in the universe, and he said compound interest. Kind of interesting. Great if you're earning it, not so great if you're paying it, of course. So I looked up the quote from another old man, which I thought was kind of interesting. Only a matter of time before US rates go negative. We have negative rates in Germany, Switzerland, Japan, Sweden, and Denmark. And a certain stable genius thinks we should also have them at zero in the United States. I see from a tweet. Kind of significant, isn't it? It kind of goes back to what Steve Catlin was saying yesterday, wasn't it? For 10 years, we've had reserve releases, reserve releases, reserve releases. And for someone like me that came into the business many years ago and specialized in US casualty, I've always been surprised. I'm not sure I've seen a long-tail book that was ever truly over-reserved. And if Stephen's right, that we have that $100 billion to $200 billion hole, and I think he probably is, that has very, very serious implications, doesn't it, for the business? So, what I've tried to do, just ignore that, it's just about the repo market and unnecessary. Let's see if I can move on. I want to come back to the client lens, the client picture. Can the brokers be agents for the buyers and sellers? Anybody here think that's possible? Just one of the questions I think we should be asking ourselves. Are interest rates going to affect pricing? How much should underwriters be relying on cash flow underwriting anyway, if they haven't got the fundamental sums right? Kind of interesting. Staying with the client lens, if I may, for the moment, and I don't want to address all the questions, just some of these questions that, in fact, I discussed with Fiona Luck, who's here with us today, early on when this thing occurred. Hey, Fiona. The first question is the one that's the obvious one. Is Lloyd's facing another crisis? Are we going to have reconstruction and renewal again after the last one 25 years ago? And I want to be very specific in my personal response to this, because my answer is no, very simply. As the stewards of a 300-year-old institution, a global quality brand, and the central fund, and the long-term interest of policyholders, I would argue that Bruce Carnegie Brown, John Neal, and John Hancock absolutely did the right thing. They were proactive, they were preemptive, and they were courageous. And I want to make sure, Fiona, you convey that back to my three friends so that they understand that. They absolutely did the right thing. And here's what's really interesting to me. How many other carriers since have kind of come along and said, that's a good idea, let's put the rates up. Let's narrow the coverage. Let's issue smaller limits. I've seen quite a few of those. I'm sure you have. Kind of interesting, isn't it? They took that first move. I was reminded of the children's story when the emperor has no clothes, and it's the child that says the emperor has no clothes, and everybody comes along and says, yes, you're right. The emperor has no clothes. So, well done. I'm not going to touch on the other questions, as I said. I'd be very happy for people afterwards to email me and get into that in greater detail if you wish. In any event, let's go back to this client issue. Throughout my career, we've been having this debate around the role of the broker and the cost of delivery. You may have seen many versions of this particular slide. There are many out there. That's the reality of what actually happens today, of course. The client, the retail broker, the wholesale broker, the insurance company, the reinsurance broker, retro broker, and so forth. Everybody's familiar with that. And everybody says, well, who's responsible for the frictional costs? And typically, of course, historically, people would say, well, it's you brokers, you evil, wicked brokers. And that's when I have to stop and just remind somebody that the brokers are appointed by the buyer. We're the agent of the buyer, we're the advocate of the buyer. We've gone through fierce competition to be appointed by the buyer. The buyer should be the one that decides whether we add value or not and how much we earn. Isn't that right? Not the marketplace. At least that's my view. We can all acknowledge that the industry is a difficult industry. It's very highly cyclical. During my day, it was a quake, a windstorm, or a flood. And guess what? Back in the 80s, we had social inflation. A brilliant, brilliant man called Bob Clements recognized that most of the clients at Marsh couldn't go out and buy products liability cover. So he went out and he created ACE. Does anybody remember that? And then Excel was created. It was the brokers that went out and responded to the demand of the clients, wasn't it? Because you simply couldn't buy cover. I know, I was a broker working in London, for Marsh at that point in time. So, very tough situation. So we shouldn't be surprised, therefore, I would argue, that carriers will choose to come into the business and leave the business because their responsibility is to their shareholders before the policyholder. The brokers act as a shock absorber and helping the clients deal with that. Imagine if you're a Lloyd's syndicate that's now been told you can't trade anymore, then there's no broker in between, and you've got to go back to the client and say, terribly sorry, old boy, can't renew. And then 3 years later say, I'd like to come back in the class now. The great news about having the broker in between is the broker can explain that. The broker can look ahead and say, look, the appetite of that particular carrier is changing, it's waxing and waning, and therefore we should look down the road and think about spreading your risk around the market a little more. When I first came into the market, we brokers were taught always place 120% on the slip. Always. Oversubscribe the slip, because then you've got the spare capacity as underwriters' appetites change. That's kind of moved on. But we can agree the difficulties are still there. There's either too much capital or too little capital, isn't there? When you've got too much capital, you chase the rates down. When you don't have enough, you can't take advantage of a cyclical change. I understand that. We've got the capital trapped in the ILS markets, stuck capital in traditional insurance markets, the problem of IBNR and IBNE, the validity of the CAT models, and loss adjustment expenses. So we can agree that the industry is difficult. I'm not suggesting for one moment that it isn't, clearly. However, coming back to this issue of disintermediation, I often ask myself, is disintermediation when the broker on the left goes to the capital markets on the right? On behalf of the client. Could that ever happen? Interesting. That debate, of course, is becoming very, very topical, isn't it? Because of InsurTech and the ability for people to communicate instantly with each other on information and so on. And it's interesting. I remember when Peter Wood created Direct Line, the ubiquitous little red telephone. Some of you may remember that. And it came to the sound of it like a cavalry charge, a little red telephone. So he's selling insurance over the telephone. And Peter actually went to all the established insurance companies at the time, the Royal, the Commercial Union, and so on, and they all said, you're crazy. It'll never work. So Peter went off to the Royal Bank of Scotland, a relatively modest-sized bank at that point in time, and took the industry by storm. And of course, it wasn't long before the other carriers said to themselves, we're better off with half a loaf than no loaf, so we'll now sell the business over the telephone, and the first customers they got were their own customers back at a discount. Kind of interesting. So, I use the term parasitic versus symbiotic precisely because I've seen so much of the discussion around whether the brokers are adding value, and I want to keep coming back to my central point. It is the client that decides who adds value. The client. He's paying the freight, it's up to him. He has to decide that. Now, staying with the client for a moment, I have this, in my mind, I have this disconnect. And I've spent most of my career working with large industrial clients who say to me, look, I'm making investments over 3, 5, 10-year periods, whether it's a new product or service offering, new buildings, plant and equipment, new suppliers, acquisitions and disposals, new advertising campaigns. Is insurance available for those periods? Or is it only going to be available on an annual basis? Bob Clements, in a great essay he wrote back in the 80s, was suggesting that insurance is losing its utility. Some of you may remember that essay. It was a very, very interesting essay. So, the interesting thing is that, excuse me, when you're thinking about it from a client's standpoint, the client doesn't buy one policy. Anybody want to hazard a guess as to what a typical industrial commercial company buys in terms of number of policies? 20, 30, 50, 60? I've seen over 100. And that's just in one country, never mind about the other countries. And some of you may have seen the mud map where the broker tries to put all this together. With different carriers, different wordings, different currencies. Absolute nightmare. And that's the reality. I've just listed a few of them there, the third party and the first party risk, for example. And it's hugely complex. And time after time, when I've been addressing people in the C-suite of major companies, they've said, why? Why do I have to buy all these different policies? Why can't somebody look at me holistically as the client? Why is it that I happily take my predictable risks and not take my unpredictable risks? You're supposed to be in the risk business, Mr. Mahoney, you and your colleagues, not I. I want to transfer the risk. I want to mitigate risk. I want to manage risk. It's kind of interesting. And it's particularly interesting, actually, sometimes when you're talking to people in the Treasury departments. I've put this up here because that was a wonderful, crisp comment from Dan Glazer. I've been privileged to meet Dan Glazer a couple of times over the years, and just like Greg Casey, he's an exceptional executive. And look at what he says. It's the age of the intermediary. Look at the pricing. Look at the prices for intermediaries nowadays. The multiples of EBITDA. Kind of interesting, isn't it? I worked for Pat Ryan. I was very privileged to work for Pat Ryan for a number of years, and we constantly bought companies. France, Germany, Spain, Italy. Watch that roll up. Pat knew exactly, of course, what he was doing and has gone on to create great things as a wholesaler. Coming back to this issue of the Treasury departments, I'm sitting there talking to the CFO, and he says, look, I've got other volatilities, background noise to my business. Currencies, interest rates, commodity prices. I'm sure you're all familiar with those. And here's the difference. There are deep and liquid markets where I can mitigate this risk, manage this risk, transfer this risk, that are open 24 hours a day, 365. Agreed? But when it comes to insurance, quite often, Mr. Mahoney, it's neither deep nor liquid. Fundamental issue of utility, isn't it? That's what Bob Clements was getting at, I believe, when he wrote his famous essay. So, how can we address that? How will it be addressed? Imagine you're the broker. You go to the client and you say, I understand the problem, the gaps, the overlaps. You want to be looked at holistically. If you give me a broker of record letter for all your coverages, wherever they are, and I guarantee to take 20% off the price, do I have a firm order? I think we're pretty sure that pretty much every client would say yes, provided it's A-rated paper, and I have the guarantee from Marsh, Aon, Willis, whoever it happens to be. Okay? I know, by the way, because I've tested this with some clients over the years. It's kind of interesting. Okay. Then there's the second question. If I save you more than 20%, can I keep the difference? And some of my clients said, well, yes, you're running the book. You're just like JP Morgan or Goldman Sachs or anybody else that's running the book. Now, it doesn't always work, as we saw with WeWork. You're running the book. Of course, for that to be achieved, it's all about data, isn't it? Data, 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 data. I wouldn't mind betting you that there are more data scientists amongst the big brokers than there are amongst the carriers right now. Go check. Kind of interesting. This is something else, by the way, that Bob Clements touched on years ago. If I have enough information about, let's say, for example, florists in Nebraska, I have 40, 50% of the market, and I know the loss rate is 25%, I can create an insurance company specializing in those florists, cut the rates by 25% and make a lot of money. And they do have that information. Okay? Will they make that next step? Can they make that next step? I don't know what the current numbers are for Marsh, Aon, and Willis about the amount of premium income they control, but it's massive. And each time they grow and buy another broker, we've just seen Marsh buy JLT, speculation about whether Aon will buy Willis or not, they're gathering that data the whole time. And they have a whole bunch of people analyzing that data the whole time. Now, I'm not suggesting for one moment that that's necessarily a bad thing. So if, for example, a broker takes an holistic approach with the client and deals with all the coverages in a single document, which he then is laying off in effect either with the insurance markets, the reinsurance markets, or the capital markets. Theoretically, he could take a French client and a US client and a Japanese client, which are non-correlated geographically and generically, and put them into a single instrument into the market, couldn't he? Or she? And if you're a carrier, you can choose to invest in that instrument, just like you would today. The difference is you've got one huge program put together that's non-correlated. Does anybody think that sounds remotely possible? You see, we've had this discussion in the industry before. We were having discussion about this back in the late 90s when I was at Aon. Could we ever get to that point? And one of the stumbling blocks was the ability to gather the data, to harness the data, to mine the data, and to make the data worthwhile. I would suggest to you, ladies and gentlemen, we're at that point. Will that transformation occur? I hope that's sufficiently controversial for some of the people in the audience. I would certainly go on to argue that the broker-carrier relationship is mutually beneficial. It allows carriers to come in and out of the industry as they should, in the interests of their shareholders, because the broker provides that continuity. In addition to entities such as ACE and XL, we've had OIL, OCIL, examples of where the industry has said to itself, we are best equipped to deal with our issues working with the brokers. I'd like to kind of wrap up on a sort of lighter note. It was actually a Financial Times journalist who wrote this a number of years ago. The insurance business is an entrepreneur's vision of hell. There are a few barriers to entry, but you try getting out again. And that's why, again, I think Stephen Catlin's absolutely on the money. And maybe he hasn't got the numbers enough. On a lighter note, of course, there's the Ingalls song. You can check out, but you can't leave. Does that sound familiar? It's kind of interesting, isn't it? Now, I didn't mean to be particularly provocative. I was asked to be controversial. I tried to be that. I want to show you something that's quite amusing. This is my first Lloyd's pass. I came into Lloyd's in 1968, got my first pass in 1970, which was before many people in this room were born. It's kind of scary, isn't it? So kind of seen it, got the T-shirt. When we talk today about under-reserving, we talk today about low interest rates, we talk today about social inflation, you kind of get the feeling, if you're someone like myself, we've kind of seen all this before. It's a kind of repetition of what it was previously, except that technology is going to change the whole ballgame, in my humble opinion. I've tried to leave enough time, if I may, for some questions, which I'll be happy to answer. Thank you very much. Stunned silence. Yes.
They also have massive commodity and forex hedging programs. How do you unravel this? I mean, I'm sure insurance companies doesn't think this whole risk.
No, that's an issue, isn't it? How do you separate that which they ought to be good at, they should manage, it's their own risk, as opposed to those which are truly extraneous? And I think maybe, certainly in the vision that I've been working on over the years, there'd have to be a double trigger, defining whether or not it was extraneous risk that they couldn't control or couldn't do more to manage, and those which were inherent to them, like producing a drug that turns out over a period of time, like thalidomide, to be very, very dangerous. So how do you separate those two? Certainly, I think that if we can come up with a product like this, it ought to enhance the value of the shares of the company, because it means that it stabilizes the earnings per share over a period of time, in my view. Thank you very much indeed, ladies and gentlemen.